This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show. The business of financial planning has seen tons and tons of M&A activities in the last 5 or so years. My guest today has been at the forefront of some of those transactions. Louise Jeffreys is the managing director of M&A advisory firm Gunner & Co. Louise, welcome to the show.
Thank you for having me, Abraham. I'm very excited to be here.
It's a pleasure. Before we get into what I expect to be a very, very feisty debate about the wisdom of advice consolidation and all that stuff, do you want to tell us a little bit about the journey that brought you into this space?
Absolutely. I think it's a bit of a funny one, actually, because I didn't come from a financial services background. In some ways, I quite like sharing this journey because when you see young people coming up through their exams and, you know, the importance of your early career. And actually, for me, it was a real sort of U-turn or step change in my career. I'd actually worked abroad, first in the Middle East and then in New York in what we called information services, but high-value subscriptions, conferences, exhibitions. I worked for Informa. I worked for Informa for 7 years, and then I worked for a company which is called Essential, I think now, but at the time it was out of the EMAP group. And I finished doing that. So I was running a marketing team and I was running a P&L in the conference division. And I finished doing that and I was living in New York, and I left New York, and I'm actually from Bristol. And I was sort of headhunted for a job in Bristol, having assumed I would come to London. I've never lived in London in my life. Right. My employers were based in London for my previous career. But I got this job in Bristol and I thought, you know what, my family are here. I've been away for 12 odd years. So let me do this. But I didn't do any due diligence and it wasn't a good fit for me and it didn't really work out. But during that time, I moved to Bristol where I had grown up, but all of my friends had had children and their lives were very different from mine. So I thought, well, I need to sort of establish myself a bit. So I joined a softball league, which I was terrible at. I was frightened of the ball. It was hard. I mean, it's called softball. It's a hard ball. And, you know, it's a bit like rounders, but it's softball. So I did this because it was a social, and every Wednesday there's about 12 teams in Bristol and they all turn up to this area and do softball. But I met a chap and I played for a team called the Bristol Junior Chamber of Commerce. So it was a sort of business-focused team. Yeah. I was in that job initially. And I met a chap called Alex Sullivan. And Alex Sullivan is the founder and managing partner of a publication called IFA magazine. And we had a chat. I had obviously worked in some of the publishing work that I'd done through Informa and EMAP, and we sort of connected. And I had established at a certain point that the job I was in wasn't really the right fit for me. And with IFA magazine at that time, so sort of 2012, 2014, more like 2013, 2014, we were coming past through RDR and people were writing into IFA magazine saying, I don't want to do this anymore, but I don't know what to do. And Alex Sullivan is an amazing salesman. And he had actually brokered the sale of his next door neighbour's business because he had a neighbour next door who was a financial planner or a financial advisor. Yeah. And that guy had been coming up to retirement. And so just completely opportunistically, he'd made some introductions and he brokered the sale. And then this guy, his name is Paul Wilson, got the proceeds of his sale and said to Alex, well, why don't we go into business together? So now I've met Alex and Alex says, well, I'm in business with this guy, Paul. And I think there's an opportunity. So it wasn't my idea. I think there's an opportunity for M&A in the financial planning and financial advice space. And so we sat down and we talked about it. And, I actually did a bit of strategy and some market sizing and, the things that you do when you used to work in a big business. And we said, yeah, we're going to do this. So we were 3 partners at the start. And the great thing is, one of the most amazing thing is we had the marketing platform of IFA magazine. So we had a subscription database, right, and we had a magazine publication that's printed and sent out that we were able to write articles for. And I had a marketing background predominantly. So the early days of the business were really around establishing the brand and also establishing how to make us different from looking at what else was going on in those early days of consolidation. So maybe that gives you an idea of where it came from, where we started. A softball team.
It's fascinating how you come completely out of the industry and, since 2015, over a 10-year period, I've managed to, establish yourself into a formidable firm. It's incredible. So I'm assuming that Alex and, sorry, I forget the other guy, Paul, are no longer in the business and you are the...
Absolutely. So I will forever be grateful because really I wouldn't have had this idea. But at the same time, they had other business interests. Right. And so really it was kind of me doing it all from day one. And that was okay for a while. And it was, of course, if I'm honest, it was quite valuable in the very early days to have a couple of men to come to some meetings, older men.
Sadly, I have to agree.
Well, I don't think you're that old, but I was in my early 30s and I was female and in financial services, when you're going to talk to a big buyer and they want to know about your experience and, you're entering the market, there was a lot of value. But at the same time, operationally, they didn't do that much. And I think for my vision for the business, and particularly around investing in the business, as opposed to perhaps using it as a bit of a cash cow, it made sense to have conversations with them in 2 different stages. Alex, I bought out first, and then a couple of years later, I bought out Paul. And then, so it was actually from 2017 onwards that I was the sole owner of the business.
Fascinating. So now tell me about Gunner & Co. as a business. What do you do? What do you do? Who is in the business with you? What does the team structure look like? And how are you different than the other guys in this space?
So we help owner managers to plan and execute their succession. So we work with financial planners and financial advisors only. So we don't work in any other segments of the market. And we often work with those companies from around 3 or 4 years before they want to sell. Now, actually, when I say work, that's possibly quite a strong, tenuous, slightly tenuous, in that we're probably doing a lot of relationship management, but also using our thought leadership channels to help those companies to prepare for sale. So we talked a bit about webinars that we do. When we launched the company, the very first thing we did to launch the company was a full-day workshop in London, focusing on the A to Z of selling your business. Actually, there was a tube strike. It was the 9th of July, 2014. And we had to cancel it and I had to phone everyone up and see if they want to sell anyway. But from day one, we've always been really committed to sharing our knowledge of what it means to sell your business. And that can cover things like the emotional impact of selling your business, as well as the legal and the tax and the due diligence and all of those elements. But what has been really, really important to me from day one, and I truly think is one of our core differentiators with the rest of the market, is that we have always been committed to sharing our knowledge. I don't think that it takes away the value of the role that myself and my team play as advisors through a deal. But one of the very early conversations I had with someone, and I talked about, what do you want to get out of selling your business? This was particularly focused on selling the business. And the chap said, well, I just don't know what I don't know. I don't know what my options are. I don't know what I should expect. And that really has stayed with me these 12 years. And we're constantly thinking about how can we fill that gap so that when somebody comes to the point where they sell their business. So when I talk about the fact that we help owner managers plan and execute their succession, 90% of that is selling the business in the market. And so when we help business owners with that, what I want us to do as a business is to help them to make decisions from a place of knowledge and understanding. It doesn't mean that they fully understand the legal process. And honestly, I don't. I'm not a lawyer. I've read many legal contracts, but would never take that role. We look to build deal teams around these owner managers because they're only going to do this once. And often these businesses are decades old. And I know, after 10 years, but even after 5 years of owning my own business, I understand the emotional attachment and the importance of what you've built. And so I think it's essential for those business owners to go into that transaction or this essentially this life event with the right level of support. And so our approach, as I said, is to start typically around 4 years before, to build a program of content that they can interact with through workshops and webinars and frankly, joining podcasts like this and insight newsletters. And we've run a sort of deal newsletter every fortnight since the day that we set up the business. And we want to take people through that for the first couple of years. We talk about, you've seen me on a webinar, we talk about segmenting your clients and I guess the thing that goes alongside that, and I'll talk about the team after, but the thing that goes alongside that I think that makes us different is that we have very deep and broad buyer relationships. So on one side, and in fact, coming to the team, we restructured the business just this year because for the first 11 or so years of the business, we operated what we call in-house a superhero model. It's a bit like a financial planner. A financial planner delivers their service, but they also win their service. Actually, if you think, and a lot of this came out of the changes came out of the Brett Davidson event that I attended of yours in January of this year in Bristol. But we've grown the team because not many people know about mergers and acquisitions in financial planning. You can't go to a base of people that have already got this experience, that have done it before. So we thought, okay, we'll bring, we brought some people with maths degrees. We actually had someone with a recruitment background because we knew we wanted to build more relationships, but we brought quite junior people in to mold them. But actually, to be able to build a relationship and maintain a relationship and account manage someone for 4 years through all of the different content that we've got, etc., and then to be able to deliver a transaction and to know all of the buyer market and to be able to take their objectives and matchmake them with the buyer, which is at the core of our service. They're two different skill sets. It's a very broad expectation. And we'd brought people in with not a lot of experience. I mean, predominantly in their 20s. And so what we realized was, as I said, they are different skill sets. So what we have in our team today is we have an account management team, and we do reach out to customers or to clients off the back of if we've been at a webinar or if we've been at an event to say, would you like to meet with some of the consultants in our business to understand about a bespoke level, to understand about your plan. And then on the other side, and so we call that a business development team, frankly. And on the other side, we have our transaction team. And all day long, their role is to deliver transactions, but also to really know what the buyer market wants. Because if we can help them through the process, an owner manager, a vendor, we can help them to really understand what their objectives are. And we put the objectives at the forefront of really all these years of planning and then the starting point of a transaction. Then if we know our buyer market well enough, we should be able to do a good job of matchmaking. And this is where I think that perhaps there's some myths in the market, but I believe that if you truly understand your business And if you've got somebody in your team who truly understands the buyer market, which is broad and deep, you can find a party. It's never going to be the same as you, but it perhaps shares a good proportion of your values, a good proportion of what has underpinned how you have built your business.
So we'll get to that buyer market and the matchmaking and the myths, shortly. But can you help me understand this? There's a lot of talk in this space about the buy side versus sell side brokers.
Yeah.
A, what is the difference? And B, what are the pros and cons?
So as a business seller, you can be represented and sort of essentially taken to market by somebody who they would call themselves on the sell side, which means that you're paying their fee. They might ask you to pay a fixed amount for the initial work, producing the documentation, producing the research, and then a fee for completing the transaction. And then on the buy side, I think the services can vary. So typically on the sell side, you have quite a clear set of services that you're going to get because you're paying. On the buy side, the advisor, broker, consultant, however you want to call them, will be paid by the buyer.
Right.
And they, I guess, will have different approaches and different, frankly, expectations of success rate in terms of how they will take that business to the market. Now, we're a buy-side remunerated firm. When I set up 12 years ago, I looked at this and the natural position of the way that we invest our time and the approach that we take, it would make a lot more sense to be sell-side because we put an awful lot of time in and yet all of our risk is on a transaction happening.
Yeah.
So we have no initial payments. And in the very early days, if you think about it in the sell side, you're not going to work with more than one party because at the end of the day, you're paying them. So in the early days, we didn't ask for exclusivity. We do now. But in those days, there weren't actually really any sell side.
Right.
And so to win any business as a startup, it really didn't make sense financially to think, okay, we're going to disrupt. Maybe, you know what, maybe we should. But I've heard it said sometimes financial planners are not that keen to pay for a few things. And so, we had that in mind. And so we launched on the buy side. And actually, I was writing some marketing material this week because I think, so the pros and cons, some buy side, operators take quite a scattergun approach because ultimately they just have to find someone to buy it. And if they can't find anyone to buy it, they're not going to get paid. And I think I think the buy side, if you're doing a really good job on the buy side, you are forced to really, really know the buyer community. And I think on the sell side, you don't always focus on that depth of knowing the buyer community. You don't necessarily have as broad a level of relationships. And so perhaps for a business seller, you may have reduced choice, but depending on who you're working with on the buy side, you're going to get more process. We approach it with a very, very defined process. And we ask our clients to work exclusively with us, which I think we're the only buy side broker that asks for that level of exclusivity. And that protects our time to do a really great process and the matchmaking. But we still get paid by the buyer. But our fees are proportionate to the deal value. So the more we get paid, the more the deal is to the vendor, the more we get paid.
I guess the one difference, certainly in terms of the fees, will be that the sell side doesn't really have, I guess, they might do, an interest in what kind of buyers you ultimately end up with, I imagine they get paid, a fee at the start of the process, and maybe there's a transaction fee that's linked to the ultimate exit. So you might make the case that they don't have a vested outcome in who you ultimately sell to. They still have a vested outcome in you selling. Whereas the buy side, essentially your incentive might be different depending on who's buying.
Yeah, which exactly. So for us, we look for our buyers to be on like-for-like terms. And in fact, that's quite good because, in the early days, now that's not the case always in 12 years, but in the early days, I would meet a buyer, they'd be really nice. And you think, oh, they're lovely. And then they'd ask for a discount and you go, all right then. And now it's so simple because I say, well, how can I possibly give you a discount? Because it's not me doing most of these deals, it's my team. And we don't want to be incentivized for any one buyer over the other beyond their proven track record through us working with them, that they do what they say they're going to do, and they're good to their word, and they're good to work on in a transaction, because so much of the transaction is actually personal, because somebody is selling their baby, their business that they've built for decades. And you need to know that you can work with someone who can connect at a personal and a human level. And so by going through those transactions, that there is a level of influence in terms of, and the same also when you get to know the personality of the vendor, you want to understand who is it that they are going to gel with best. So I think that there is prioritization from my experience in my company. There is a certain level of prioritization, mostly based on proven track record, to do what you say you're going to do.
Of the buyer.
And so I'll give you an example. I think I was at a conference or somewhere, and I remember someone talking about this concept of fish and chip. So fishing is, let me tell you that your business is worth 5 times recurring income, and let me draw you in. And then we're going to go through, and I'm going to cut out the rest of the market, and then I'm going to chip away. That happened once in 12 years in my experience, and we didn't work with that buyer again. And I think that is part of the value of having those deep relationships with the buyers is, and for us actually, when we work on on transactions, we're not, again, I think my experience of some of the other buy-side approach is they're a bit more sales-driven, which means they make more money than us. But they really sort of just do a bit of a real volume game. Partly because also they've not got this exclusivity. They really need to try and make money wherever they can. And that's at the cost of really, I think, a process and understanding the objectives of the seller. But we only look to do 18 to 20 transactions a year. So my team have time to really be end to end on a deal, which is what you would typically get on a sell side mandate.
So let's talk about this. We had these debates, myself and Anthony Cathy, and at the CISI conference about consolidation and whether or not this is ultimately a good trend for the industry. I obviously, without any surprise to anyone, didn't think that, this private equity driven, debt fueled consolidation is ultimately best for the profession and the client. Anthony takes the opposite side of that and did a really good job considering.
He did sway the audience a little bit.
He did sway the audience, but I don't know. I think so much. by 12% or something.
But you were still in the majority.
Well, I don't. It's okay. but of course, I take it that you didn't particularly like my argument. So here's your chance.
Well, no, you know what? I think the starting point, and I suspect the reason why there was that sway in the audience is to say, I think let's say we've got about 4,000 FCA regulated firms with less than 5 advisors. And according to ChatGPT, around 2,000 of them have a single advisor, no more. Advisor, so none of those could do an EOT or a management buyout. We also know that the average age is 57, 58. So we need to have retirement options. I think this is part of what Anthony's speech that perhaps resonated with the audience is, well, how are these people going to retire? And if they've built businesses, why shouldn't there be value in their businesses? And I think the sheer volume suggests to me that it would be very, very difficult to sustain an M&A market and to sustain the number of transactions that have happened and that need to happen without significant amounts of external investment. I don't see how. Otherwise, the option for all of these business owners who've worked really hard is to close up shop. And I think also, I think I've done a number of transactions with Clifton Wealth or Clifton Asset Management, Anthony's firm. Originally, we worked with them, I would say, as a mid-sized regional player in Bristol when we were looking at businesses for sale in Bristol and South Wales. And now they've taken their funding from CBPE and they're looking more nationally. I think the last transaction I did with them was in Essex. And from my experience, they're a really transparent, fair buyer. They run a restricted model, which means that from day one, they have to look at how can clients be integrated or not. And I think this is one of the most important things for a buyer is to be really clear on day one about what everything looks like, because ultimately, to come back to this matchmaking, their restricted model and their charging structure and their client service proposition, that can align to a lot of different businesses. And there are so many different buyers out there, not all of them private equity backed, but the private equity brings the opportunity for investment, for academies, for, in my opinion, innovation. We talk about does consolidation and removing lots and lots of small firms take away innovation. But I think about my business, if I had the opportunity to merge into something bigger where we would have more access to resources, we do have a marketing manager. I think that's quite unusual for a business of 10 people to have a marketing manager. I believe strongly in marketing, but you can have access to these services that I don't think as small businesses, they have either the capacity financially to be able to invest in their business or the expertise. If you're a small advisor firm and you want to hire a marketing person, well, you're going to need to hire someone pretty experienced because you probably don't have the experience to manage them, if not. And so I think that the investment brings resources. And I think that we have a market, we have people that need an exit. And I think it would be very difficult to facilitate that, whether, over the last 5 years or looking forward without some external investment.
Okay. No, it's good point to make. So the way you see the profession evolving is essentially bigger and bigger firms, larger private equity backed businesses, and ultimately less in terms of number, in terms of, solo advisors and, the small firms, the 2 to 5 advisor firms. That's where you see the future of the business.
I think the 2 to 5 advisor firms, or even the 0 to 5 advisor firms, are the most tricky to establish a legacy-based succession plan, right? So I went to the States a couple of years ago to a Dimensional conference, a deals conference with Dimensional. And I was really, it was amazing to see how much RIAs or financial planners in the US could build businesses that had legacy. They were actually taking private equity often to be able to buy out leadership team, incumbent owners, but the businesses had legacy. But those businesses, and there were so many of them, typically had about $1 billion under management. Our scale, the scale of the businesses in this market, if you're 5 advisors and under and, 200-300 million under management or below, what other options are there if you want to retire? If you get to the point where you're a 30-person firm, then you could look at an EOT, or you could perhaps look at a management buyout. And I still think that actually external investment may bring more resources. So many financial planning business owners are business owners by accident, and many of them own their job. When you're in a larger organization, you have marketing brains and finance brains and technology brains and, AI. You just can't access in a small business. And so I think for the profession, I think that's a benefit. But if we have 4,000 sub 5 advisor, we're never going to only have 10. I mean, there must be a future where there is space for smaller firms to continue to grow. And perhaps this kind of evolution of startups that grow to a certain stage and then look to take funding or look to join a larger group at a certain point. I wonder that I don't know the answer as to what happened 20 or 25 years ago to get all these financial planners that own businesses that are now sort of trying to sell. Because I don't think that's a time when the banks stopped giving financial advice. I think that's more recent history. So what happened 25 years ago? You know my financial planner in Bristol. Actually, I know exactly what happened. He worked in a big organization and he didn't like it, so he went and set up his own.
You go.
But why? But that what stopped? Well, why is there like this demographic bubble, like a set of baby boomers because everyone came back from the war and we all know what happened. But why did they all do it then, and what's stopping people doing it now? We've got all these universities. We've got universities trying to bring people into the profession. We've got academies trying to bring people into the profession. We've got a lot of private equity-backed companies financially incentivizing or financially supporting people coming into the profession, but we don't have the volume that must have been there for all these businesses to be now coming up for sale.
Yeah. Well, I mean, I guess you can take either side of this argument. If you look back, say 20 years ago, 15, 20 years ago, you had a wave of large acquisitions with firms like Think Destiny, these firms going around buying, I think it was backed by the likes of AXA. My history is a little bit dated, buying firms and consolidate. You had some sort of consolidation happening. Not many of those actually, succeeded, if you like. Then you have a second version of it, which I think is being done slightly better, but not entirely without its flaws. So I guess we will see ultimately where this lands.
I think 2019, my history is 12 years or, what I can read post that. But 2019, 2020 was a big time where we started to get more private equity. The likes of Ascot Lloyd have been private equity backed. The likes of large Perspective have been private equity backed since before that. Succession
was probably one of the first private equity backed in the Mark II version.
And then we had, this influx of either, quite small private equity houses backing leadership teams like Nigel Spears and Dominic Rose that came out of Quilter, and they are backed by a company called Cabot Square. They bought their first business called MKC, and they've built a business beyond that. And there were quite a lot of either businesses that already exist, like Skerritts, backed by Sovereign, or, as I said, management teams being backed around 2019, 2020. And it did add a lot of competition to the market. And to win a deal, to win a 150 million under management, advice, 3 advisor firm, 2 advisor firm, 3 advisor firm in London, it's quite challenging to win a deal for those buyers. And so, and at the heart of the seller, almost always, is what's going to happen to my clients, what's going to happen to my team, and then lastly, what's going to happen to me. I'm going to see these people in Waitrose. I'm going to see them in a golf club. Are they going to tell me that it was a good idea? And I think over the time, people have got better at doing their due diligence on the buyers. And this is what we talked about at the CI site, really, through some of the Q&A, is there's good and bad on both sides. The number of financial planning firms that I have met that have kept their fees very low and as a result, frankly, can't afford to service their clients because they've taken on so many, because they need to have the turnover to pay for a team, but they can't deliver all of their annual reviews because they've got too many clients. And on the flip side, we have seen some poor behavior in some of the poor behavior is probably a bad word, but operational challenges in some buyers that have perhaps bought too many too quickly. But I think that there are a lot of different buyers out there. Many of them have investments. And I ran a round table in September where I had 20 of the big buyers around the table with Simone, the editor of FT Advisor. And we do it each year, and we have a bit of a discussion about the biggest challenges. And actually, interestingly, the opener of that discussion was around when you're buying a multi-advisor firm, the clients are really, really important, but actually the conduit to the clients is the advisors. And often those advisors may not have benefited from the sale, or they may have, but not at a large level. And a lot of the discussion was about how can we essentially be employers of choice? How can we pick up financial planners through a transaction, and they want to stay in our company, and they can see that the learning and development is so good outside of a smaller, lower budget firm, that they can see how we work as a community. And I think if we think about consolidation as a lot of people doing the same thing, because integration and it's a bigger business buying a smaller business and making the small business do what they do. I think that I love process. I think process gives you space for innovation. And so growing by integrating firms, if what you're doing is right in the first place, I think that aids or gives more opportunity for innovation in the future. And I also think, on the last point on this, is that when you're talking about some of those big businesses, the spotlight from the consolidator is huge on those businesses.
From the regulator. From the
regulator. And so actually the level of compliance and therefore to a degree, the level of safe hands that those clients are in, I think is higher there than it is in some directly authorized or AR firms in the smaller scale.
Yeah, I mean, my argument on this stems from the fact that, financial planning, almost unlike any other profession, is a deeply personal. Yeah,
and I haven't mentioned the client, as yet.
Relationship, and almost without fail. I mean, people will argue this shouldn't be that way, but almost without fail, the bond between the planner and the client is almost always stronger than the bond between the firm and the client. And that's the nature of the beast. So often the way that you've set out the case is that, it's just in the interest of the advisor. Somehow the advisor has to find an exit because, as you say, the average advisor is 57. And so therefore, at some point, they've built a business. They have to crystallize their life's work. Interestingly, I first found out about you through my friend, Julian Gilbert, through some work that you did with him, acquiring a business. And I see that sort of path for solo advice firms who want to sell their business and want to exit to sell into another financial planning firm. And if you look at the numbers, you say something like there are 2,000 solo advisors, advisory firms in the UK. Let's say on average, 10% of them have to exit over the next 10 years. I mean, this is a problem that we should have started fixing 15 years ago. But anyway, we're here. We didn't have this business model and all that. If you imagine we need to sell 200 businesses, solo firms, and they will be selling to firms, other financial planning firms, I think valuations will be far more reasonable than what it is today. I think the outcome, the process of ingestion will be much easier. Again, I am talking about an ideal world that doesn't exist, and that gives an opportunity for the next layer of firm, the 2 to 5 advisory firms. And let's not forget, these are or should be more stable business. If you have 5 advisors within the firm, each of them doing £500,000 or £400,000, you have a £2 million business. I completely disagree with you that management buyout is not visible for those firms. 2 to 5, they are. I know many firms who are going through that process. Now, it's a 5-10 year planning process, not a 3 to 5 year planning process. And I have absolutely no issues. I've seen this in the US, actually, with firms in that level, 2 to 5 or 5 to, where's the category? And the FCA has another 6 to 50, but actually the median advisor is 9. So it's not like they are, massive conglomerates. But I have no problems with anyone doing anything. They can do whatever they want. But I will actually love to see those firms take minority investments. And we've seen this model as long as financial planners are leading the charge and growing as businesses and provide this kind of regeneration opportunity for younger people to come into the business and ultimately grow in the business and own the business and take it to the next level.
But I think that can happen.
I don't run the world. I'm not king yet.
But I think that can happen, right? Alongside the private equity picking up some of the segments that they're picking up.
I think that what's happening right now is that, the private equity backed consolidators are basically bidding
pricing out
the price out of the reach that that true financial planning firm will want to pay. I say an organic financial planning firm would want to pay for, and also bidding it out of the hands of the next generation of planners.
I think the latter. I think there's probably a fair point there, in part because that next generation, where are they even going to get the money from? Anyway?
They've built a business that they cannot afford to own, or they've helped build a business that they cannot not afford to own. I don't know. I may be completely wrong.
I guess one of the things, I suspect we might be running out of time.
No, we're not. Keep going.
Okay, cool. One of the things I believe, rightly or wrongly, and maybe this is too simplistic, that you've built a business, you're the financial planner now, you've built a business, it's in your hands to decide who you want to sell to.
Absolutely.
I'm working on a transaction now where a very large national, who had lots of reasons why it would be a great fit, bid significantly more than a regional, non-vertically integrated, non-private equity-backed, chartered firm. And the seller is selling to the regional, chartered, non-private equity-backed.
Interesting.
They're taking the hit. And also, one of the things that we advise, I guess, is you can't never make a decision on the headline price, because if the fit isn't there for the clients, the fit is for the clients and for any ongoing advisors. If the fit isn't there, then whatever they say is the price at the start will not be how much you get paid at the end. So it always makes sense, in my opinion, and it's not my business to sell, but it always makes sense to start with the fit for your clients and your team. The window of price. Now I'm taking away, as you said, the internal buyouts. I agree that external capital makes that difficult, but also external capital builds a marketplace of a price.
Absolutely, yes,
There are a lot of transactions going on, as you said. There's a lot, and maybe with more, the price will go down. Yeah. There'll be some pressure.
Well, I mean, like, there's a lot of good things in this, which is ultimately giving, good exit for the owners who've built, a formidable business. And we have to play the game on the field, by the way, in terms of that is the game on the field. I just wanted to ask you a few questions before we wrap things up. So I know you said there are different types of buyers in the marketplace, but can you put them in a couple of buckets, in a couple of groups?
Definitely.
Please.
So small regional firms, and by small, I mean probably 300 to 400 million under management. They probably have limited backing, or they may have some sort of bank debt and things like that. They're typically looking to buy businesses very local to them, let's say within a 30 to 50 mile radius. They may have more or less experience in transactions, and I think the level of experience is really important. And so that can be a little bit of a challenge for them to win competitively. Also, they may not have the deepest pockets, and so they may not be able to make the biggest bids, to your words. But they often limit the level of culture clash between the seller and the buyer. And this is really talking about, I don't think you can sell 150 million under management to someone who's got 300
so
million.
So it will have to be like sub 100 million.
So let's say sub 100 million. So I'm going to start there, and that's the small regionals. And then you go to large nationals who have offices all over the country, loads of experience in doing transactions, access to funding, and are very able to articulate their proposition because they've done it many times. But for the seller, this is where you're going to get the biggest culture clash. This is where you're going to go from, how do your clients, and this is something we say when we present pros and cons of different buyers, how do your clients go from being one of a few hundred to one of thousands of clients? Where is the risk there for your clients? And then you've got the middle ground. And this is a market we like. And that is regional firms that have some sort of backing, a little bit like what you said in the States. So they still have their culture, but they're perhaps more like 30 or 40 employees in total. Again, they're still looking regionally, but perhaps the backer may have those firms in multiple different locations across the country. Those firms have their own way of working. But the backer has experience of doing transactions and has money to pay for them. And I think that can be quite a sweet spot, quite a happy medium, that you can sit in a firm and you can see that there's 30, 40, 50 people around you, not hundreds, but you also know that they've got backing and they've got experience in transactions, and they've got a deal team that knows what they're doing. And I think that if you're only going to sell your business once, and then you've got the person down the road who's smaller but actually has so much limited experience, you're putting perhaps a bit more risk. So I would go with those three buckets.
Okay, good stuff. And is there how much steam is in this consolidation trend? Is still got a long way to go? Or?
Well, I mean, this is how long has Gunnar & Co got an opportunity in the market? I mean, when I was doing my research, I was actually really surprised to know that there were still 2,000 single advisor firms out there. Yeah, that says to me that we speak to people all the time that are 8 years out, 10 years out from sell, that are still in that build phase. And in reality, I think there's lots of different reporting on how many transactions are done each year. I actually think there's probably around 150, 160 transactions.
That's what I thought, yeah.
There's normally about 100 to 95 to 110 announced, and we track all the ones that are announced. Right. And then obviously we have a sense of who isn't announcing and what's being done down the pub. And so we make an estimate of about 150. So I think there's 5 to 8 years. After that, my question, if we've got time, is what's the plan for these bigger firms?
They'll start emerging. They'll start consolidating.
Yeah. I totally agree. They'll start. But let's come back to the client. Yeah. They're mostly making their money on the baby boomers.
Yeah.
Okay, so we talk about this generational wealth transfer, but if I put myself in that demographic, in that generation, I have a financial planner because, of course, I work in this industry and I'm a business owner. But I don't know anyone else, literally not a single one of my friends that has a financial planner.
One of your 30-year-old mates.
Oh, Abraham, thank you. But and then you go even further down to 30-year-olds, and I don't think they ever have a faintest idea what a financial planner is for. Yeah. And so are these firms there for at-retirement advice, where people that have complex needs and they can make money? But we've got this bubble of these baby boomers, which has grown those professions. So when those baby boomers pass on, what happens next? And where are the disruptors going to come? I mean, these 30-year-olds don't phone each other up and talk on the phone, do they? So you talk about this depth of relationship with the clients. I possibly would challenge you on that, in that if you look at something like COVID, during COVID, everyone had to do their meetings in Zoom. What proportion of clients after COVID said, no, I really still want you to come to my house and have a cup of tea and pet my dog because you're such an important part of my life? Always within a group of clients, you're going to have a segment that have that depth of relationship. But I would argue that there is also a segment where the relationship is more transactional and they have therefore continued to manage that relationship virtually. And they're getting what they need from the service. And I think also, but if we look at this whole thing about annual reviews and clients that weren't getting their annual reviews, where's the deep relationship there? Like if we say that it's underpinned.
But the FCA, I'm just taking, the FCA says that's not a widespread issue. It's 80-20. I think
it's some very large companies. Right. If you think about this polluter pays and the report that was written.
But the FCA says, something, I think it says something to the effect of, about 1 in 10 clients haven't got the ongoing advice that they ask for. I'm not justifying it. I'm just saying that.
That's quite a lot though. If 10% of the whole financial population of this profession didn't receive their service and they paid for it, that's quite a lot. And I do that. I think when we think about, I think that if you're going to sell your business, you have to look at your clients in the eyes and say, I think this is a great new home for you, to the best of your ability, through doing a good process, through really doing your due diligence on the buyer. I don't think you should ever, that's my personal opinion. But I do think that there are many relationships that are deep, like you said, but I don't think they all are. I think some of it is a service transactional relationship.
2 questions and we have to wrap this up and we'll get kicked out. One is, I know it's an unfair question and they say tell me the price and I'll tell you the deal. But what is the going rate these days for a decent firm?
Do you know, in the way, the simplest way for me to say this would be, if you look at your funds under advice, and, you know, I don't think that buyers are only trying to buy your funds under advice, which is what people say a lot. Yeah. But if you look at the price as a proportion of funds under advice, because I analyze this over tens and tens of rows of data every year, then I would say between 2.4 and the absolute average would be about 2.4 to 2.8. Mm-hmm. But you're looking at sort of 2 to 3% of funds under advice. And I think by using that mechanism, it's a bit easier than saying, okay, let's say I said 3.2 times recurring income. Well, if you're on a 1% model or a 50 basis points model, actually those proportions spit out different numbers and the attractiveness and, you know, the numbers are different. So if you look at a percentage funds under advice, I would say 2.4 to 2.8. Interesting.
I'm glad. I'm petrified that you actually did give me a range. Thank you.
Sorry.
and finally, what is the biggest mistake that you've seen firms who are selling, advisors who are selling, make over and over and over and over again?
Okay. Can I say a couple of things?
Yeah, please.
So the first one is about commitment to the transaction and understanding that when you're doing a transaction, you're running your business at the same time. And perhaps trying to do it all yourself. You don't tell your team. You know, you don't actually, half of them don't actually want to work in the evenings. So they're trying to do two jobs and it takes a very long time and you can lose confidence from the buyer. Time kills a deal. So underestimating the level of effort and commitment that you need to put into the process and not having the right support around you, I think is one. Two, and it's not too often, you see it over and over again, but you've got to get the skeletons out right on day one. Because it's about trust. You know, I said, one of the things we look at is, you know, those two guys are going to get on with each other when they're working on a transaction for a year. And so if something comes up in due diligence that you haven't disclosed earlier, that same thing, if you brought it to the table on day one, may not have been a problem. The problem is when it comes out later, say, well, what else are you hiding? How come you didn't let us know that, you know, you'd done these film schemes? The cover-up is worse than the crime. Yeah. Absolutely. And that doesn't happen too often because, of course, lots and lots of firms haven't got skeletons in their closets. And then I guess finally, this is really, really hard, but as an owner manager, when you're selling your business, you're selling your baby. Nobody's got an ugly baby, right? Look at my baby, it's beautiful, right? But actually when a buyer is looking at it, they're looking at it through a different lens. And I think it's worth knowing that it's going to be an emotional time when you sell your business. It's not just for the seller. It's not just a business transaction. And I think having self-awareness and thinking about how you're going to handle yourself when somebody is perhaps spotting things you could have done better, how you're going to respond in an open-minded way and not a defensive way of, well, yeah, I know, you know, his teeth are going like that, but it's still beautiful. You know, I think you need to prepare yourself emotionally as well.
Fascinating stuff. Louise Jeffreys, thank you for your time. Thank you for your wisdom. Thank you for bringing a dose of practical and common sense to this mad world of consolidation, as I see. But thank you very much. Long may it continue.
Thank you very much, Abraham. It was a pleasure to be here.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.